The biggest mistake I'm seeing right now, people trying to guess where rates are going. The reality is, even the big banks can't agree on that. So let's break down what they're predicting and more importantly, what it means for you. Hi, I'm Becky Perro, mortgage broker for over 20 years. And if there's one thing I've learned, it's that trying to outguess the market usually doesn't end well. So let's start with the consistent part. Right now, all of the big banks, RBC, TD, Scotiabank, BMO, CIBC, and National Bank, are more or less aligned on the short term. They're kind of expecting rates to sit, not drop dramatically, not spike higher, just hold relatively steady for a while. And this is important because a lot of people are still expecting this big drop in rates, and that's not what's being predicted right now. Now, here's where things get interesting. When you look a bit further out into the next couple of years, that agreement completely falls apart. You've got one group of banks saying rates are going to start moving back up again, gradually, but up. And then you've got the other group saying, no, we're just going to stay right where we are. Flat, stable, no big changes. So which one is it? And this is the part I really want you to take away from this. It's not going to be about who's right. It's about what this tells us. And what it tells us is this. There is no clear path right now. Even the biggest banks in the country, with all their economists and all their data, don't agree on what's coming next. So how are you supposed to choose? If your plan right now is, I'll just wait until things are more clear, I get it. But also clear based on what? Because the people who are supposed to have the clearest view don't. What does this mean for your mortgage? So let's break it down to what matters for you. The Bank of Canada rate directly impacts variable rate mortgages, lines of credit, and home equity lines of credit because all of those move with prime. So when the Bank of Canada cuts rates, your payments can go down. When they raise rates, your payments go up. And just to give you a rough idea of what that looks like, for every quarter point change, so 0.25%, that's about $12 to $13 a month for every $100,000 of mortgage. So if you've got a $500,000 mortgage, it's roughly about a $60 swing per month. And if rates move more than once, you really start to feel that. Here's where I see the problem coming in. Everyone's trying to make decisions based on where they think rates are going. And right now, that's a shaky strategy because the range of outcomes is still wide. Rates could stay flat. Rates could move up. They could come down a bit more. There isn't one obvious direction. So instead of trying to be right about the market, a better question right now is, what if I'm wrong? Am I still okay? Because that's really what this comes down to, isn't it? It's not just about getting the lowest rate today. It's about how long you're realistically going to keep the mortgage, whether you need flexibility, how comfortable you are with change, because in a market like this, structure matters more than the headline rate. So if you've been trying to figure out where rates are going, the honest answer right now is even the big banks don't fully agree. And that's why your strategy matters more than ever.